Dear learners, this is Shashi Ramachandran, and in this video, we are going to have a quick revision on the chapter admission of a partner, and this is from accountancy subject class 12th. So we'll understand this chapter through the mind map. Okay, admission of a partner. In case of a reconstitution of a partnership firm, the old partnership gets dissolved and a new partnership is created. Now, admission of a partner is one of the case or one of the example of reconstitution of a partnership firm. So, under this admission of partner in this chapter, we prepare mainly three accounts, that is revaluation account, capital account, and one statement, that is revised balance sheet. Now, starting with this revaluation account is a nominal account. And in this, we prepare we record all the profits and loss, by which is because of the revaluation of assets and reassessment of the liabilities. So here, like increase in a asset and decrease in a liability is added, or we can say it is recorded on the credit side of the revaluation account. Same way, decrease in the asset and increase in the liability is deducted, or we can say it is debited to revaluation account. And the reason is very clear, because it's a nominal account. This increase will give you the profit to the firm, and decrease in asset will give a loss for the firm. Now coming to this thing, like you can see the format here. The format says revaluation, two sides, debit and credit side. So we can see here that increase in the liability, decrease in asset, and a unrecorded liability, which of course will increase the liability of the firm. These are all losses for the business recorded on the debit side of the revaluation account. On the other hand, these are the profits for the partnership firm, that is if there is any decrease in the liability, increase in an asset, or an unrecorded asset. And the balancing figure will be profit or loss. If credit side is more, then we'll get profits, and if debit side balance is more, then we'll get losses, which will ultimately transfer to partners capital account in their old ratio. So after this revaluation account, we prepare our capital account. So again, in the capital account, before this capital account, we should also know that how to calculate the new profit sharing ratio and the sacrificing ratio. So basically, sacrificing ratio is calculated to treat the valued goodwill. Okay, the goodwill share which is brought in by the new partner. So either again in this treatment, what we have like when the new partner brings a share of goodwill in cash, or when a new partner enables to bring the goodwill in cash. Another thing, there is a hidden goodwill. So these three treatments we need to understand in case of treatment of the valued goodwill. So when a new partner comes in, he brings his share of goodwill, that is termed as premium for goodwill, and that is distributed in the sacrificing ratio to the sacrificing partner. Now, for detailed understanding of these two topics, a new profit sharing ratio and treatment of goodwill, watch my videos. The link is given in the description box. Now, why we need new profit sharing ratio? Sometimes, like the capital of the new firm is adjusted according to the new profit sharing ratio, or we can say that is proportionately adjusted, or proportionate capital is decided by the partners in a new firm. Okay, so let's see first thing as a capital account, how it is shown. So in the capital account, you can see here the format of a capital account, where we have debit and credit side. So we have a column for A, B, and C. A and B are the old partner. C is entering into the business as a new partner. So what we'll start with the balance amount, that is balance BD of old partners A and B. If this any balance appears on the debit side, that will be written on the debit side, means, or you can say any balance appearing on the asset side of the balance sheet that has a debit balance. So that we are going to record here in this. Okay, now balance CD is the first thing, then the cash brought in by the new partner. So here we are only recording the capital amount which is brought in by a new partner, and the goodwill share what he is bringing will be distributed to the old partners, or you can say sacrificing partner in their sacrificing ratio, and that is termed as premium for goodwill. Coming to the next thing, these are the accumulated profits which appear on the liability side of the balance sheet, and these accumulated profits are to be distributed to old partners in their old ratio. Then there is a revaluation profit. If any profit arises from the revaluation, that is transferred to the capital account. On the debit side, we have balance and then appearing goodwill. This is a goodwill which appears on a already appearing on a asset side of the balance sheet. So we need to write it off. Advertisement suspense account, P&L account, debit balance means the one appearing on the asset side. Preliminary expenses, these are the accumulated losses which are supposed to be written off. Again, old partners, old ratio. Then we have revaluation loss. If it's a profit, then it will be recorded on the credit side. If it's a loss, it will be recorded here. Finally, we have a balance here. Okay. Now these are the balances which appear in a revised balance sheet. Fine. But again, as I said, in case the revised balance sheet, like a new partnership, they decided that the balance should be uh, their capital balance should be proportionate. So how we are going to treat it? So again, that is also the part which you need to understand, that how this capital adjustment in case of a admission of a partners, adjustment of a capital under this admission of a partner. Okay, the first method on this, if they want, like first method says that a new partner brings in the capital, but the capital is not given directly. So what is given here, like you are given with the amount of like new partner comes in, only the information is that he is going to bring a proportionate capital. So we need to find out what amount of capital he is bringing. So the first step will be, we'll find out the total adjusted capital. That means we are going to prepare the capital account. We are going to write all the transactions will enter in that. That is treatment of goodwill, premium for goodwill, reserves, accumulated profits and losses distributed, revaluation profit losses entered into that, and finally we get adjusted profit of these two partners. And taking these two partners adjusted capital, we are going to multiply by their remaining share, by the share reciprocal of their share. Okay, when I say reciprocal of their share means we are only finding out the old partner's share. Okay, so we then the next step goes as the total capital will be again the new partner's total capital multiplied by new partner's share in the profit. So what total capital we got in second step, that we are going to use to find out the capital of a new partner. Okay, I've given an example also how to calculate remaining share and how it will be shown. So let's move to the second one. The second case will be when new partners capital is given, and taking that as a base, we are going to calculate the old partners, or you can say all partners capital, which should be proportionate. Okay, so here comes the first will be the total capital of the firm will be calculated based on new partners capital. So new partners capital multiplied by reciprocal of new partners. So when we are taking new partners capital, we are going to multiply by the reciprocal of his own share. So this way we'll get the total capital, and the total capital will be distributed to all the partners in their profit sharing ratio. Okay. I'll explain this with the help of an example also. Here the question says A and B are partners and they are sharing the profit and loss in this ratio 2:1. Their adjusted capital is already given, means after all the adjustments, premium for goodwill, reserves, revaluation profits, everything is treated. So now they have 60,000 and 35,000 as their capital. Now C has is to bring the capital which is proportionate, and he is coming for 1/6 share. So we don't know that what amount of profit capital he is bringing. So we need to find out that. So as I said, the first step will be add the adjusted capital of old partners A and B, 95,000. Now this next step is we have to multiply this. To find out the total capital, we have to multiply this with the reciprocal of their own share. So 95,000 will be multiplied by the reciprocal of their share. So how we found this share, their share? One here, the new partner is coming for 1/6 share. So it will be 1/6, 1 minus 1/6. So that comes to 5/6, and the reciprocal will be 6/5. So this way we got total capital of the partner of the firm. So now we are going to calculate the 1/6 part of the new partner, which new partner is going to bring. Well, let's take another example in the same case. 3 is to 2 is the old partner's share. 70,000 and 40,000 are the capital after the adjustments. And C has to bring one fifth of the combined capital. Now be very careful. It says only combined capital. No need to find out total capital. So here what you are going to do, you just have to add these two to find out the combined capital of the partners. Fine. So the first step will be to add the capital, and another step will be to find out one fifth of that. This is the amount which a new partner is bringing. Well, moving to the second case. Second case says that 5 is to 3 is a old partner's ratio. New ratio is also given. One fifth part. Adjusted capitals are given 70,000 and 65,000. New partner's capital is given as 40,000. Now the question says the capitals of A and B are to be adjusted on the basis of C's capital. So it clearly says that you have to find out the adjusted capital of A and B. That means it is to be proportionate. So we'll take this as a base. C's capital will be taking as a base for this. Okay. So for that we'll take first step as C's capital, and also we'll take a reciprocal of C's capital only. Okay, so this way we'll get the total capital of the firm is 2 lakh. Second step goes where we are finding this 5 is to 3 is to 2 is a new ratio. So we'll divide this 2 lakh in this ratio only. So this way we got the balance of all the three partners. Okay, now in this case one more thing we have to see, that what some amount of cash they are going to withdraw, or they are going to bring to adjust to this capital. Fine. So old capital we know it was 70,000 and 65,000. New capital is now 1 lakh and another is 60,000. So the difference is the amount which is the cash amount which they are going to bring, either bring or withdraw. Clear? Okay, now after this capital account, after understanding this capital, next thing is the revised balance sheet. This is a statement where we are writing all the assets and liabilities revised value. Means any change in the asset, addition in the asset will be added, and any deduction in the asset or the liability will be deducted. Okay, so that will be recorded here in this. So we have all this here, you can see very clearly. Okay, also one more thing we have to notice here in this chapter, that is treatment of accumulated profits. Fine. Now accumulated profit are the one which are recorded in the which are given in a balance sheet. So as I said, accumulated profits and losses are to be distributed. When it comes to the accumulated profit, let's see how the treatment will take place. Okay, you can see here accumulated profits are general reserve, reserve fund, workmen compensation, investment fluctuation reserve. So here accumulated profits are to be distributed. You can very clearly see here also that when the question is silent, or when the accumulated profits are to be distributed, or when accumulated profit or losses are not to be shown in the new balance sheet. So these are the cases when we are going to distribute all these all these reserves, and there will be no balance in the reserve for the new balance sheet, or we can say the accounts we are going to close. General reserve, contingencies reserve, P&L account, investment fluctuation reserve, workmen compensation reserve, all these are to be debited to old partners capital account in old ratio. Same way accumulated losses also are to be closed, that is by reversing, like it has a debit balance, so we are going to credit here, and debit, what we are going to debit, old partners capital account. Again this will be written off in old ratio. Okay, in this one more thing which is important, that is when it says when accumulated profits are not to be distributed, or when accumulated profits are to be shown in a new balance sheet, or when accumulated profits are not to be adjusted, are to be adjusted. So here what it exactly says, that these are the cases when these any of these will appear in my new balance sheet. Okay, so now we have to be careful. We cannot close the account by distributing the amount. What we have to do is we have to find out the net effect. So in this, I have explained very clearly and with detailed thing in my one of the previous video. The link will be given in the description box. You can watch that video to understand it more clearly. Now here what it says, general reserve, contingencies. So all these reserves, accumulated profits and losses, we are going to take in one go. Like we are going to find out the net effect of that while converting it into one value. So all the accumulated profits are to be added and all the accumulated losses are to be deducted so that we get one value. Now remember, if the value is positive, then gaining partner's capital to sacrificing partner, and value is negative, then sacrificing to gaining. So this is one entry, adjustment entry, which we are going to pass to settle down this effect. And now of course these balances will appear in our new balance sheet. Okay, now moving to the next, in this scenario only, treatment of accumulated profits, we have workmen compensation reserve. So workmen compensation reserve is to pay off the compensation to workers in case of any accident. Okay, if no compensation is payable or occurs, so in that case the you can say the amount is distributed among the partners, old partners in old ratio. Fine. So remember, if there is a claim, then only will take away that claim amount and that will be shown in a new balance sheet. Okay, but if there is no claim, that will be distributed to the partners. So let's understand this also. Very treatment of workmen compensation reserve. Coming to this, as I said, there are different cases here. We can see the cases here. If there is no claim, if there is a claim which is just equal to the workmen compensation reserve given in a balance sheet, or if it is less. So coming to this, the first one, if there is no claim, so entire reserve will be distributed to partners in their old ratio. When the claim is just equal to the reserve, then claim the workman compensation reserve, of course we are going to close it, but we are going to open a new account called as a claim on workman compensation reserve, and this is going to appear in our new balance sheet. Means now the workman has claimed it and it becomes a real liability which is supposed to be paid off. And if workman compensation claim is less than the reserve, then the part of claim of course will be credited so that it can appear in a balance sheet, and rest of the part will be distributed to the partners capital account, old partners old ratio. And in case workman compensation reserve is more than the sorry claim is more than the reserve, now we don't have amount to cover up the claims. Reserve is not sufficient reserve is not there. So and that's a loss for the business because we have to take out the money from other reserves. So in that case, the workman compensation reserve and revaluation account, these two will be taken to cover this claim on workman compensation reserve. That means if the reserve amount is less and the claim is more, the claim extra claim will be taken as a loss and recorded in a revaluation account on a debit side. And don't forget to close this revaluation account by transferring the amount to old partners old ratio. Okay. Now, next one is treatment of investment fluctuation reserve. Again, this requires some specific treatment. So, these two I'm explaining separately. You have to take care of these two. So, IFR or investment fluctuation reserve or fund is created to meet the fall in the value of market value of investment. So, let's see in this how many cases are there. Okay, what we have here is treatment of investment fluctuation fund, where we are given with this. See again, now we have to compare with book value and the market value. Book value is the one which is appearing in the books, and market value, which we see at the time of change in a partnership firm, we compare and again correct our values of these reserves as compared to the market value. Now, coming to the first one, when these two are equal, that says no loss. So we are going to distribute the funds. If book value is less than the market value, in that case, what will happen? Of course, market value is more and book value is less. It's a profit for the business. So the IFR will not be disturbed. So in investment fluctuation fund will distribute because there is no role of it. Okay, and the increased value of investment will be recorded in revaluation. Again, revaluation credited because it's a profit, and we need to close our revaluation account by transferring the amount to P&L, profit and sorry, partners capital account. Third case, again in this, if the book value is more than the market value. Now, book value more than market value, of course, is a loss. Now, this loss will be covered by investment fluctuation reserve. But we need to be careful here that book value, if this loss, the difference is like less than investment fluctuation reserve, or if it is equal to, or if it is more than that. If it's less than, the difference is the loss is less than reserve, then we can easily cover the loss as well as we can distribute rest of the money to partners capital. So this will be the journal entry. If this is just equal to this, then we of course will cover our loss here, and losses are covered here means investment amount will decrease, will be credited. If loss is more than IFRS, so that investment fluctuation reserve will, entire investment fluctuation reserve will be used for covering the loss. Plus, we need to record extra losses in our revaluation account. So, revaluation account will be debited. And again, as I said, please do not forget to record this revaluation. Close this revaluation by transferring the amount here, in this case, to partners capital account. So this way, uh, we revise the entire chapter. You can see once again that how it goes. So all these terms you have to remember. Hope you like this video. Share this video with your friends and do subscribe to my channel Exuberant Learners. Also click on the bell icon to get the latest video updates on my channel. Thank you.